We have this opportunistic bend to us. When we are screening for opportunities out there, we generally are screening on a yield or price basis. If we're looking for companies or credits whose debt securities have underperformed, we talk about a value-based approach.
The main thing that differentiates the approach at Artisan compared to other places where I've worked is our focus on business quality. And what that does is that allows the company to generate more cash flow over time and thus pay down debt.
We think cash flow is extremely important because that's what services our debt. It's very simple. Asset value can evaporate very quickly if the cash flows don't support it. When you're investing in credit assets, you've got a binary risk profile. You want to make sure you can have that cash flow to pay down.
The reason that we need to pay attention to the benchmark is because most of our competitors are closely aligned with the benchmark. It's a way for them to limit their risk or tracking error. We are much more nimble than an indexer. It allows us to take more differentiated positions, and when we have high conviction, we know how to generate outperformance.
We don't just stay high level, on the run index names. We just really dig into the full opportunity set in the market. We don't just take kind of what the street presents to us. We don't just look at the most liquid credits. We'll go deep down into cap structures, off the run, different types of securities that our competitors may not always look at.
Your average mortgage today?
We're benchmark aware, but we have the flexibility to go up and down the capital structure. The ability to purchase loans and bonds gives us, I think, an advantage over peers that might strictly be looking at a bond index as an example. When we see opportunities within a capital structure to invest in loans as an example that might have traded off for various reasons, it definitely gives us an advantage.
Our loan portfolio can be a risk dampener where we can use loans as a surrogate for bonds. We can use it in an environment where spreads are tight.
We describe ourselves as generalists with sector tendencies, and I think it's the best of both worlds. So what it does is we do have our focus universe. So the advantages of having a focus universe is it kind of builds an institutional knowledge about the sector, but we don't call ourselves specialists because that enables us to not have opinion on every single constituent of the industry, which is a waste of our time. This methodology helps us focus on the most promising ideas and then also get to learn the details and the intricacies of one specific focus area like a sector.
By being broader, we have the ability to have a better sense as to where the market is on a relative value perspective.
And so that kind of helps us build a cleaner, purer picture and build the institutional specialized knowledge and have a deeper and a wider coverage.
High degrees of investment freedom, to me, give us the flexibility to be able to express views in ways that you can't do if you have a very rigid benchmark that you focus on. You can't replicate going into loans, bonds, converts on a busted basis when it's really more idiosyncratic than that. So that is what we think gives us a massive edge throughout a cycle.